This episode is in partnership with Moodys Analytics. Moodys on Climate Solutions deliver transparent and robust data, analytics and insights designed to integrate into your existing business workflows. The foundation of our value is data and our approach to financial quantification of risk. Navigate climate risk with confidence, trusted data, financial insight, better decisions.
Hello, welcome to this Moodys Analytics podcast. My name's Christian Doherty, and I'm joined today by three Moodys experts to look at the evolving world of risk and how insurers are adapting to it. In this episode, we're looking at how insurers are quantifying and assessing different climate-related risks and how modelling transition and physical risk are creating a whole new challenge for the industry on both sides of the balance sheet. So I'm going to kick off straight away, and perhaps we could start with Gavin Conn, who's Director of Strategy and Consulting at Moodys. So Gavin, could you give us a sense of what's driving the focus by insurance on transition risk modelling?
Yes, certainly. I suppose a short answer to your question, and this may come across as a bit cynical, would just be to say regulation. So there are financial risks faced insurers arising from this transition to a net zero economy, and regulators want us to explore those risks. They are increasingly carrying out climate stress test exercises, and listeners may be familiar. We had the Bank of England CBES exercise carried out in the UK a couple of years ago. As well as exploring the impacts of the physical risks from climate change, this also focused on transition risks. And by that, I mean the risks that arise as we move from a carbon-intensive economy to a lower pollutant, greener economy. More recently, the French regulator, the ACPR, they have launched a climate stress test exercise, and that looks at transition risk. And then even if I look outside of Europe, there are other pilot exercises on climate risk, for example, in the US and in Hong Kong. So regulation, definitely one factor, but there are other factors at play. One of those is that insurers have now announced their net zero transition plans. So arguably announcing the plan was the easy part. And now they have to put this plan into action and start to reduce their carbon emissions. And that includes the emissions of their investment portfolio. So having announced their targets, insurers will now be judged against those. And then a third factor at play is the investment strategy and how the insurer's asset allocation will change. So how they choose to potentially divest from carbon-intensive sectors. So the transition scenarios typically assume that some form of carbon tax is introduced, and this should act to incentivize more investment in new tech, such as new infrastructure for the energy system, retrofit buildings, switch to electric cars. But this transformation is going to cost companies, and insurers and asset managers may want to identify which sectors are likely to underperform and which may outperform.
Okay, that makes sense. And so obviously data is going to play a huge role in this. So what data is available to assess that transition risk? And could you perhaps give us an overview of the choices of scenarios there?
Yes. So in terms of trying to quantify the impact of transition risks, it's probably no surprise to those of us who work in insurance that they are typically applying scenario analysis. So insurers are very familiar with scenario modeling and stress testing, so it's the natural place to start. There are multiple sources of scenarios. I'll mention some of the key ones that insurers are using. So first up, we have the IPCC. So the IPCC is the Intergovernmental Panel on Climate Change, the international body for assessing science related to climate change, provides governments with the regular assessments on the scientific basis for climate change. And they prepare assessment reports, and I think that the latest report was AR6. They have released over the past decade scenarios known as the RCPs, and they have now amended their approach and explore scenarios which consider how society might evolve and different challenges to climate change mitigation. A second source of scenarios is the International Energy Agency. So they produce what-if scenarios for how emissions might evolve, and they look at current energy policies and trends, and every year they publish the World Energy Outlook, and that contains 3 scenarios, one of which is a pathway to net zero. I've mentioned about the important role of the regulators that they have to play, and here the typical source of scenarios is NGFS. the network for greening the financial system. And it's a collaboration of central banks and supervisors, and their scenarios are specifically designed for use by the financial sector. And they publish free releases of scenarios, including a couple of hothouse scenarios, but also some transition scenarios. And the CBERS exercise I referred to a minute ago is based off NGFS. And then one more source of scenarios, and this time more of a focus on the asset management community, is the UN PRI, so the Inevitable Policy Response Group. They are designed to support investors to incorporate transition risk into portfolio analysis. So the focus is very much on transition risk, and they anticipate that policy announcements will ramp up over the next 5 years. So I think that's four potential source of scenarios there. So there's no doubt others.
And just to add to the alphabet soup there, in terms of the regulatory requirements there, we're looking at things like ORSA, and disclosure is obviously a huge part of this as well, sort of TCFD. Could you give us just a quick sense, sort of briefly, of what those regulatory requirements are?
Certainly, and I've already mentioned some of the stress tests which are being conducted by the regulators, CBERS, in 2021. In the UK, we have SS319 that sets out the PRA's expectations for how insurers will manage risk. You mentioned the ORSA, so under Solvency II in Europe, we have the ORSA, and that EIOPA have set out their expectations. Again, there's a requirement for scenario analysis. It states that insurers should look at two scenarios, below 2C and above 2C. You mentioned disclosures and TCFD. And I also think, firstly, it's worth remembering that TCFD applies beyond just the insurers and the banks, but much more widely, and in the UK to all premium listed companies. But continuing on this theme of scenario analysis, that's covered under the strategy pillar of TCFD, and there's a requirement to assess the resilience of your company to the climate scenarios. And then moving on to accounting, the climate disclosures are also soon to make their way into the financial reports. We have IFRS S2 on its way next year, and S2 sets out requirements for climate disclosure, and same idea as TCFD, adopts 4 pillars, and again mentions that you must do some scenario analysis.
So you talked there about the introduction of new, particularly IFRS S2, which is a big part of that's going to be the shift from qualitative to quantitative disclosure. This is a huge question, but are insurers ready for that shift, do you think?
First remark is that there's a great deal of uncertainty in the modelling, probably more so than any other area of modelling I've been involved in. You've got uncertainty around the climate sensitivity, so the degree of warming, given a doubling of concentration of greenhouse gases, uncertainty around government policy, uncertainty around speed of technological change, how much we'll use carbon capture, and obviously uncertainty about how the financial markets react. So despite this, there are advantages to trying to quantify the impact. I think qualitative narrative is too open to interpretation. Now, quantifying doesn't always mean we'll get the right answer, and I'm aware that in the UK there has been some criticism of the results emerging from some of the models has been a bit too benign. But by attempting to quantify the risks, we and insurers get a better understanding of the exposure. So the model risk is huge, but we shouldn't let that put us off. We need to update the models as the climate science develops and as we progress on the path to net zero. And just a final point there on a recent development on the quantitative modelling. NGFS, which I've mentioned, are working on a set of short-term climate scenarios, again targeted at the financial institutions, but it's going to focus on a 3 to 5 year horizon. So that's much more aligned with an insurer's typical ORSA. And the idea is to consider the shocks that may take place in financial markets in the nearer term from changes in policy response and effectively pricing in climate risk.
Great. Okay. Well, thanks, Gavin. That's great. So I'd like to turn to Josh Matthewman, who's the Senior Director of Climate Change Product Management there at Moodys. So Josh, there's lots of uncertainty around the impact of climate change on catastrophe losses and whether and how that risk is changing. Could you give us a sense of how that's impacting on the general insurance market, perhaps?
Yeah, absolutely. And I'm kind of happy that Gavin talked at the end there about the near-term impacts, because I think we've seen a lot of drivers in the regulatory space, but really this is an issue of portfolio management. So every policy and treaty which is written today really has this inherent exposure to near-term shifts in risk due to climate change. And that's even if the shifts are gradual. So the prevalent approach in the market currently has been that really as the kind of climate changes, I will divine that in real time by looking at the weather and the claims counts, and we'll kind of adapt and change on a 12-month rolling basis to kind of reduce that risk. But I mean, the problem with that is it's really reactive. So if you're divining it from the last 12 months of weather data, you're relying on these gradual changes telegraphing accurately what they're doing in real time through the events which you're observing. And we just know that that doesn't work for catastrophe perils because they're just so volatile. And if you're waiting to react to concrete claims signals coming in over the last 12 months before you de-risk, well, I mean, that's just moving the problem from proactive risk management into claims management. So there's a real risk of recency bias for both of those approaches. So it just places too much weight in recent loss experience, which is really volatile. So to be honest, I think right now in the market, we're seeing some of the issues this 12-month look-back approach to climate change can bring, because we're seeing primary carriers pulling coverage entirely in some territories. We're seeing reinsurers who are totally running off or reducing their cat books with climate change cited as a factor. So I think there's challenges with it. And what we're seeing more and more, I think, is instead of attempting to spot and react to these gradual shifts on that 12-month look-back cycle, the question is, how can we plan and manage for that as part of our everyday portfolio management? And is that a differentiator then for portfolio performance? Because ultimately that's the question. But for that, really, we need to then look at near-term projections of risk. So to Gavin's point, kind of what are we looking at over the next 3, 5, 10 years? And for example, using some of the pathways which were referred to earlier, such as those representative concentration pathways or the RCPs. So there's some areas where the near-term insights can be valuable. And this can include identifying sustainable strategic reinsurance relationships. So we know that many reinsurance contracts are very tactical, so they come on and off risk from year to year. But we also know that a lot are multi-year and strategic. So while they renew every 12 months, there's a longer-term relationship between the cedant and the reinsurer, and that's often pretty critical to delivering a medium-term business plan. So if you're entering into that kind of relationship, you need to factor in those near-term shifts in risk. And to be frank as well, what's the likelihood that your reinsurance partner might just vanish into thin air because they're doing that 12-month look back? And then from the primary side, you've got the question about whether or not your current portfolio strategy will be sustainable in the medium term. So there's a cost associated with churning a portfolio. You want to reduce that and avoid that disruption if you can. And in the end, although I've not really talked about regulatory requirements, it all feeds into demonstrating compliance with some of the requirements which Gavin spoke to earlier on, things like SS319 from the Prudential Regulation Authority in the UK, or getting this kind of insight into your ORSA as part of business as usual.
That makes sense. So in terms of sort of looking at this at the real world, I mean, what tools are available for insurers, and I guess also for reinsurers, to model some of these impacts? Are there any examples you can give us maybe that might bring it to life?
Yeah, sure. And I think there's been a real increase in the last 2 or 3 years in the availability of tools which do look at this projecting out of climate change impacts on catastrophe risk. And I think just as Gavin was saying earlier on, the regulatory disclosures were an early driver of the activity, but we're seeing now using those in those business as usual near-term risk assessments. But the important point, though, is that where we've had greatest traction there is where the approaches taken are aligned with current approaches today, because catastrophe risk in 5 or 10 years' time is still catastrophe risk. So we need to approach it from a catastrophe risk frame of mind. But one example where these models have been used already in the market includes our strategic reinsurance discussion from earlier on. So you could take the tools and you could produce, for example, loss metrics for a reinsurance treaty. You could look at average annual loss or the probability of attachment of a treaty. Look at it now, look at it in 2030 under perhaps a moderate or severe emissions scenario. And if you do that for all cedants, can you identify the ones for whom those metrics are deteriorating faster than their peers? So the tools are able to do that, I think, increasingly. And then you have that question over, which do you select? And you can evidence the choice of selection. And then for the cedants, or perhaps their broker, have they then done their own analysis? Can they show how they're going to mitigate this, or are they aware of it, or are they not aware of it? So the tools all come around to assisting this kind of analysis. And for that cedent and broker side of it, really, in that case, you can look at sustainability of their primary portfolio. So using the same tools, so you're aligned across reinsurer and cedent, to look at, again, 2030 and present day risk metrics, and can you identify emerging risk hotspots in that portfolio? Is affordability going to become stressed in some areas and not others? So, if you have that granularity in the tools, you're able to differentiate this. And what insurance product innovations or resilience measures on the homeowner level, or what diversification strategies can you test and then develop in these tools to sustain risk at current levels, or dare I say, improve risk? And that's really important, I think, in not just for this policy retention issue, but also for a social responsibility issue across the market, because we're aiming to avoid and avert affordability issues in advance, rather than just abandoning people on that 12-month rolling cycle further down the road.
Fantastic. Brilliant. Thanks very much for that, Josh. Fascinating stuff. And it'd be great now to get a sense, to get some insight into how life insurance now is starting to consider the impact of climate change on mortality and longevity. I know there are two, there seem to be two elements that aren't often considered together, but this is one for Ragav Sawhney, who's Director of Product Management for Life Risks. Ragav, what are those key considerations for life insurers regarding climate change impacts on mortality and longevity?
Thanks. Yeah, so that's really good question, a good introduction into the whole problem here. So I think a useful starting point is to think about the overarching split between the physical and transition type risks, and give some examples of how that might directly feed into life insurance risk. So on the physical side, we know empirically that periods of excessive heat can lead to temporary excess shocks in mortality. And this is particularly true for older and more frail parts of the population. So if we have climate change increasing the frequency and severity of these types of events, that would manifest as lower mortality kind of improvements and more mortality shocks manifesting over time, which basically means the trend of mortality improvements would be impacted. And this is important for long-term life insurance liability, so longer term assurances, but also things like annuities or defined benefit pensions. So this also affects pension plans and pension schemes as well. Additionally, there's the kind of mortality and morbidity impact from natural catastrophes increasing in frequency or severity. For example, floods and storms and all other types of catastrophes. Now, on the other hand, the part that's kind of a bit harder to quantify traditionally and less obviously linked to it, but still probably equally, if not more material, is the socioeconomic impacts of climate future scenarios on life expectancy. So we know that socioeconomic variations between countries, even within cities, is a key determinant of how long people can live. A few years ago, there was a graphic of the London Underground tube map, and on each stop they had the life expectancy, and you could see by not travelling very far that this varied a lot, and a lot of those differences are socioeconomic. So therefore, any kind of responses to climate change that affect kind of the future prosperity and living standards, variables such as GDP, but others would also plausibly move the dial on life expectancy. And we think that when we consider both of these impacts together, we do get a material impact of different climate futures when we kind of have the combined view of direct physical impacts and the socioeconomic impacts together. And then this becomes actually on the balance sheet in terms of, say, future liabilities, the difference between quite different, say, policy implications or different climate futures will materially change the numbers there on a reporting basis there for life insurers. So it is material, and it does require kind of piecing together different areas of physical risk and socioeconomics to get that combined impact.
That makes sense. And could you sort of briefly explain how the modelling anticipates different impacts in different regions of the world?
Yeah, so this is really important, that there won't be a one-size-fits-all approach. So we know that, for example, in a temperate country like the United Kingdom, the impact of increasing temperatures would also have to be considered alongside the fact that winter excess mortality is a significant driver of mortality. Now, this would be a slightly different and quite drastically different pattern in different geographies. Countries that are already more arid and dry and have higher temperatures generally, higher temperatures from that starting point would likely exacerbate the direct physical impacts of temperature change. Also, we know that certain areas, depending on their geography and distance from the coastline or rivers, will be differently exposed to natural catastrophes such as floods and storm surges and so on. So there's kind of an obvious intuitive different exposure to mortality from climate change as a result of different geographies that needs to be considered when these models are developed for specific regions, depending on the exposure of life insurers. The other part on socioeconomic variation, now there will be still variation there. We know that different countries have different built environments, different capacity to deal with the physical impacts of natural disasters. But also the fact that they're at different stages of development means the socioeconomic impacts of future climate change can differentially impact those countries. And that's an important concern as well, to kind of more bespokely kind of fit these perceived socioeconomic changes into regions such that they more accurately represent where the different countries are in terms of their kind of human development index, but also the types of industries that they have in each country and how transitions might affect them differently. I would say, though, that there is an overarching theme here, that this is a systemic event. There, in the long run, the kind of more significant impacts of climate change, both in terms of physical impacts and globally, economically, in an interconnected world, are hard to disentangle. So we do think there'll be a lot of overlap there between certain large-scale socioeconomic impacts across the world. And this kind of highlights the need to model each country and region specifically, but also see where the similarities and common exposures to the risks are, and how to best collaborate to get the best outcomes here. And that will be both in life insurance and all other spheres when related to this topic.
That's great. Thanks very much, Ragav. So as a bit of a wrap up now, Gavin, can you briefly, and I know it's a huge question, but can you help us understand why, although these market and non-market risks are often modeled separately, why insurers should consider the impact of climate change on both of them together? Is there a real world example of how these two things interact, perhaps?
Yeah, and an example is probably best here. So we worked with a P&C insurer in Europe, and their objective was to incorporate climate risks in our analysis into their ORSA, so physical land transition. And on the liability side, the insurer had our NatCat models in place to assess their exposure to risks such as flooding. And on the asset side, our goal was to embed a set of climate scenarios so that they could quantify the losses on the investment portfolio. And one of the challenges is to achieve consistency. For example, if you have RCP 8.5, so the high emission scenario being applied on the liability side, then on the asset side, the assumptions you're using to project your portfolio must also be consistent with RCP 8.5. So I think, in brief, if you have comprehensive coverage of the risks of physical land transition and you have consistency of the modelling, then you can start to make informed choices using the the climate scenarios.
Absolutely. And so I suppose from your perspective then, as a final question, what would you want people to take away from this discussion, and maybe how Moodys can help?
Yeah, I'll take this on, I think, and I think I'm really happy that Gavin used the word consistency, because that, I think, is consistency and alignment is a really important thing to kind of take away here when thinking about a holistic approach to climate change risk management across a business. And I mean, just starting on the property side of things. So, are your risk management tools and approach for climate change consistent with best practice today? Right, and I talked about that earlier on. But if you're managing a portfolio using dollars losses and dollars of allocated capital, then how do those same metrics change? Under a different climate, and then across the property and casualty and the lifelines, is your approach consistent there? So, are you looking at the same scenarios? Are you using common data? I mean, to Ragav's example earlier on, if we have projections for heat stress, which are used to inform our life scenarios, can we align those with the temperature projections used to drive our property catastrophe scenarios? And then zooming out one more level, to the liabilities and assets, as Gavin's just spoken to, are you taking the same view of risk across those two? So, for example, if your underwriting function has identified this emerging risk hotspot in your liabilities portfolio, do you have other exposure there in real estate or other investments which is exposed to the same risk? And are you aware for it and are taking similar kind of informed actions on both sides? And then I would say that's all regarding physical risk, but going out one more step, and this is really to Gavin's point, kind of how do you align across the transition and the physical risk as well? Because we know there's correlation there, that activities which will aim to reduce our physical risk can end up being quite disruptive in terms of transition risk. So, we know that correlation needs to be captured in this kind of way. So ultimately, I would say this all comes together to answer that question that a firm really cares about here, which is, what's my climate change risk, right? Putting all that together. And that's why at Moodys, really, we aim to bring all of this stuff under one roof. So it's about looking at location level, physical damage risk scoring to our kind of life scenarios, or looking at catastrophe portfolio metrics under a changing climate or transition risk. Because doing so, we can really help clients to get a meaningful answer to that question. So, and really, it's not just a case of how will climate change impact my business. It's really about knowing that. How am I going to outperform as a business?
Excellent. Thanks very much. Well, that's given us a really interesting, comprehensive view of this topic, which is sure to run and run. So it just remains for me to wrap up, to thank you for listening, and to thank all three of our experts today, Gavin, Joss, and Ragav. Be sure to join us for the next podcast in the coming weeks. But in the meantime, thanks again and goodbye.
This episode is in partnership with Moodys Analytics. Moodys on Climate Solutions deliver transparent and robust data, analytics and insights designed to integrate into your existing business workflows. The foundation of our value is data and our approach to financial quantification of risk. Navigate climate risk with confidence, trusted data, financial insight, better decisions.